Hello and welcome to our special Q&A session all about market volatility. I'm Myron Jobson, the Senior Personal Finance Analyst at Interactive Investor, and joining me today is Craig Rickman, who is our pensions and personal finance expert, Lee Wild, who's our Head of Equity Strategy, and of course, none other than Sam Benstead, who's our Fixed Income Lead. Gents will join me, but before I get started properly, I'd like to remind viewers that you can submit your questions, any questions you might have for us via Slido. I believe the link is in the description. So without further ado, let's get started, shall we? I mean, this past couple of weeks has been such an interesting one, let's just say that, for want of a better word, for investments. And it's all been stoked, I say all been, market volatility has been stoked by one man, it seems, President Donald Trump and his tariffs and trade wars. I haven't necessarily seen anything like it. Lee, what do you make of it, or what do you make of the reaction of financial markets?
Well, I think markets are just reacting to the facts as they arrive, and they don't know what those. It's almost impossible to predict. I mean, we didn't know. There's speculation that the tariffs would come along when they could do more severe than everybody thought. You had the tip attack with China. Difficult to predict how that was going to go. Then certainly no one predicted the rowing back, the double blink from Trump. First with the 90-day pause, and then with the technology cause, and so no tariffs on technology from China, that sort of thing. So, but who knows what happens next? So very difficult for financial markets and individual investors to predict the future.
And businesses. I mean, how can you, as a business owner, plan for the future when there's just so much uncertainty? Now, I think that's a key concern. I think that's perhaps why you see financial markets, global markets, go haywire all over the place. This volatility, that levels of volatility we haven't seen since the start of the COVID pandemic.
And that's something that investors are going to have to get used to during this Trump administration, it seems.
Yeah. Okay, let's dive into the first question. And this first question is from Steve, who writes, I get that markets have recovered from downturns in the past, but is this one different? Lee, I'm going to come to you on that one.
Well, yes, it is different, but they're all different. And, I've been around more years than I care to remember. So I've worked in the city during the dot-com crash, during the financial crisis, and Brexit in 2016 and COVID. 2022, we had the inflation boom and the interest rate increases. Markets came up about 15-20% then. So it's not unusual. And all of those circumstances have a different set of triggers quite often. So yes, they are all different, but the outcome has always been the same over in the subsequent years. Markets have always recovered. They've always gone on to record highs. Now, that recovery takes different forms. It may take longer in some circumstances. I mean, from the financial crisis, it took quite a number of years. From COVID, it was very quick. And similarly, with this Trump crash, the bounce back has been very rapid, but all within a week.
Yeah.
But this may or may not be the end. I mean, there's one suspects this story has much further to go.
Yeah, I think so. I suppose the main difference this time is set the T word, right? Trump. Does a man-made market volatility mean that there might be a different trajectory when it comes to recovery? Then I suppose I'm asking almost an impossible question. I'm asking you to glance at your crystal ball.
But it's back to that unpredictability, isn't it? It's sort of when you certainly financial crisis crumbs. I mean, nobody, some people did predict it, claim to, but for the most part, it caught people on the hop. But this Trump changes his mind so quickly, that anything could happen. So, but whether we've seen the bottom of this sell-off or the worst is over, let's assume it isn't, and we haven't. Then the markets could go lower clearly, but they could in time, they will bounce back. That historically, that's what stock markets do. They price in the bad news, and eventually stocks become cheap, and people have that is often overpriced. People price it in, and markets overshoot to the downside. Then people start buying back in. Circumstances change. You recover from a recession. That's the way that economic cycles work.
Yeah,
and then that's reflected in share prices, and markets go on to bigger and better things.
Yeah, I think this actually ties in with a second question, which is, do you have any advice for investors other than don't panic? I mean, this is something we have all said in our, our day-to-day roles. Investors don't panic. Sam, perhaps I can come to you on that one.
Yeah, well, the most important thing is to not sell when markets fall suddenly. Volatility in equity markets is a feature, not a bug. Every 4 or 5 years, we do get a 20% bear market. That's what we've seen this time. And every time, like Lee said, there are different triggers, and they are uniquely scary for different reasons. At the moment, it's a man-made problem. COVID was obviously very different. 2008, the financial crisis. Every single time, it feels like things are getting out of control, and that's why you see huge reactions from markets. But looking at the data, going back to 1980, a study from Vanguard found that 13 of the 20 best days in that 45-year period came during down years for markets. And those best days often followed the worst days. So really, the worst thing you can do is sell on the bottom. The best thing you can do, I think, in my view, if you're a retail investor, just had the new ISA year, is keep investing. If you can split your contributions to every month, free regular investing with II, that's a really powerful way of not panicking, of buying when things are lower and staying disciplined. And that, for me, is the most important thing right now.
Yeah. And Greg, do you think it's hard to not panic, I suppose, when you look in the news and all you see are reports of doom and gloom, and you see, people who might not understand investments understand the color red. Red typically means bad, isn't it? So with all this panic, the coverage of it all, does that make it even harder for the everyday investor, the everyday person, to just keep calm and carry on?
Yes.
Open advice.
Yeah. I agree. I think there's a difference between not panicking and not worrying. So I think worrying is perfectly natural in these circumstances. It's like the pink elephant effect. If you say to someone, whatever you do, don't think of the pink elephant, they inevitably will. And I think that's very much where we are now. So like you say, there's a lot of the media reports, all the coverage, telling people not to worry. So it's quite natural that might be the reaction. But I think there's a different, that's the bit that's sort of, is okay to deal with. Kind of beyond that is other decisions you make. So I think that, worrying is one thing, but I think, going back to what Sam said, is try not to make any panic decisions. That doesn't mean you should necessarily, avoid doing anything different. For some types of investors, this may be a trigger to look at something else, to maybe look at to do something sort of slightly different than what they're doing already. But I think the key is, try not to make any knee-jerk decisions with your long-term wealth.
Yeah, I think the market volatility, market's always volatile, but this period of heightened volatility has come at a really interesting time at the end of the tax year and at the start of a new tax year. Some people might have been fortunate enough to receive a bonus from their workplace and thinking, right, how can I best use this bonus to improve my wealth over the long term? And they're looking at investments, and you're looking at the market and you're thinking, goodness me, I want to make the most out of my tax allowance, but oh my gosh, if what's going on, how would you broach that? Lee, actually, I want to come to you on that one.
Well, I mean, I think so. We should say that these sort of market developments are an opportunity. If you're a lot of investors will, you probably do the right thing. You just sit tight, not panic. They'll stay calm.
Yeah.
But others who are perhaps more happier to have a higher risk tolerance, perhaps, who are happy to take a bit of risk, would view any severe market drop like we saw last week prior as an opportunity to pick up what could be cheaper stock. And we've seen that people who were quick and nimble and able to get in and time the market. I mean, that's another question: timing the market and time in the market. But anyway, we were able to time it at the bottom and at the right time, and just a week later, would be sitting on significant gains.
Yeah.
That sort of quick trading, frequent trading is not for everybody. But I'm just raising that as an opportunity that does arise.
Yeah. And which brings me to my third question, actually. So, when we talk about market volatility, we always talk about the benefits of having a well-diversified portfolio that's invested across different regions and across different assets. So this next question from Brad is a multi-asset fund all the diversification I need? Sam, what do you think?
It depends on the funds. I think it's a very good place to start. As always with the funds, you really want to look under the bonnet and see what's inside there. So if you're in a multi-asset fund with no gold in it, that's a great place to be. Gold's been one of the really powerful diversifying assets at the moment. Some of the that's actually gone up this year, but not all multi-asset funds have gold in. So maybe you want to check that. If there's no gold in there, you might want to buy a gold fund yourself. You can do it via an ETF very cheaply, and it's very simple to do so. The other thing to look at is the bonds. So generally, the more bonds you have, the more defensive the multi-asset fund is. A 60-40 equity to bond split is typical if you're heading into retirement. And actually, as opposed to 2022 when bonds were a really poor investment because of rising interest rates and rising inflation, bonds look much better today than they do then. And that's because interest rates have risen, you're getting better yields. Central banks can actually move in and cut interest rates if they feel the economy is under pressure. Could happen if we see a big global recession or a UK-based recession. So actually bonds could be a really defensive asset.
Yeah.
Over the past few weeks, they've been neutral. So that's actually not so bad. If equities are down 10, 15% and your bonds are flat, the more bonds you've owned, the better you look comparatively. So actually, bonds are a good place to be invested, I think, at the moment. So check your multi-asset funds. Bonds far more effective than they were a few years ago.
Oh, sorry.
Yeah, I'll just go back to the question. Yeah, multi-asset fund, all the diversification they need. I think it depends. It sort of boils down to your personal goals, your circumstances. I mean, if you're sort of a younger investor just starting out, then a one-stop shop multi-asset fund might do a good job for you. Alternatively, if you're in retirement and you're drawing down from your pensions and savings, then having everything in a single fund might not work for you. You might want to look at something different, maybe sort of bucket strategy, something like that, where you have different types of assets with different levels of risks in different buckets that you can draw from in different market periods, depending on how things are performing. So in answer to that question, it could potentially be one multi-asset fund, but it really does depend on several factors.
Yeah, and I know that one thing I want to add on this is I know index funds. A lot of people talk about index funds as a solution, and especially one that tracks the world. And I think people who are just reliant on an index fund should know that they might be heavily skewed to one region more so than perhaps they thought. So, for example, if you track a fund if you invest in a fund that tracks a FTSE All-World index, you'll see that majority of your investment is exposed to US equities. That's majority. Because we've seen the markets being really volatile, US markets being really volatile over the past couple of weeks. And so, when it comes to achieving true diversification, perhaps you might need to look beyond that one global tracker if you want to achieve a true global diversification.
Yeah, definitely. And also on that, you're also quite exposed to the currency as well. So you've had this double whammy of a weakening dollar and weakening US share prices. So in sterling terms, you lost money on the asset prices, you lost money on the currency. And if you thought you were diversified in a global equity fund, you've actually found out you weren't. But if you'd held on for 10 years, 5 years, you're not going to be able to happy with returns you generated from that US heavy approach.
Yeah. And we've had some few new questions actually just pop up as we were talking. I want to take this one from Paul. Thanks, Paul. It says, what opportunities, industries, or investment types do you think this downturn has opened up? Lee, perhaps I can come to you on that one.
Get your question.
Yeah, so it says, what opportunities, industries, or investment types do you think this downturn has opened up?
Well, off the top of my head, it was. There's a lot of cheap technology stocks.
Yeah.
Valuations were the big talking point earlier in the year. Have been for for quite some time.
As in, have they been overvalued?
Absolutely, yeah. And historically, you could argue that they have. You could argue that the S&P's been overvalued, but the markets keep going up. So valuations don't necessarily hold a market back. But at some point, corporate earnings have got to catch up. And I think the markets had reached a stage where they'd sort of plateaued. I think people were wondering what's going to happen next. Either the market decides that they are comfortable all of a sudden with these high valuations and even higher valuations, so markets go up, or corporate earnings do catch up, and the up cycle continues. But now we've got, I'll take say Nvidia for example. I mean, $150 not that long ago, a share was trading at $95 last week. That sort of area. So people who are nervous about paying high valuations on what are attractive stocks with a bright future, you're far happier paying $95 than $150. So the market just needed this clear out. It needed a spring clear, a breath of fresh air, a bit of a reset, and that's what we're seeing. The reset perhaps is not over. There's lots. We've got corporate earnings season upon us, and we'll see how the early stages of the tariff policy are hitting company profits. Probably a bit too early to tell, but certainly the forward-looking statements are going to be keenly closely watched.
Well, some companies are already making some adjustments to their pricing because of the tariffs. I think Sony recently said that they're going to increase the price of their PlayStation as a direct consequence of the tariffs. So it seems that some companies are being preempted, even though the effects of the tariffs, bearing in mind that tipping delayed for 90 days, are yet to come to fruition.
Yeah, and this the exemption of technology from China, that it might be short-lived, we're told as well. Yeah. So again, goes back to that whole unpredictability. But in answer to that question, so looking for opportunities, certain stocks are a lot cheaper than they were. Yeah. So if you liked a sector and you thought it was too expensive, now it's an awful lot cheaper. But you do have to remember that the circumstances have changed slightly, and the unpredictability of the Trump administration makes any investment sort of, certainly the short-term volatility, that's what you would have to expect probably across sectors.
Yeah, I always think times like this, I think of that Mark Twain quote, like history doesn't repeat itself, it rhymes. And you can really see that it applies to financial markets. When that dip happened, was it the Thursday morning? So that was after Trump gave that speech announcing the tariffs on the Wednesday evening. It was an indiscriminate dip across, seen almost all global markets, indiscriminate, right? So it depends. It doesn't matter whether the company has a great balance sheet, its P ratio is actually quite attractive. Sorry, price earnings ratio is quite attractive. It was an indiscriminate dip. And that was also the case during the pandemic, at the start of the pandemic, also the financial crash. So, there are definitely opportunities to be had. I suppose is what you said earlier, Lee. It's, make sure you have, obviously we need a rainy day fund, but those who can afford so might benefit, as things improve.
In the short term, you see a flight to safety, and that can maybe only last a few sessions, but you see utilities do rather well. BT, it had quite a lot of support, BT, ahead of the crash anyway, but that found extra support. It was going up quite sharply as others were falling. So you do see those sort of moves into perhaps more UK-centric stocks and the defensive utilities as people wait to figure out really what's going on.
Yeah. Right. So one more question before I want to read out some customer trends. There's a few questions relating to that, but here's one I just want to read out. So it says, what's the difference between the FTSE All-World and MSCI? I'm guessing All-World. I can answer this. They're very, very, very similar. There's really, really small differences. You might notice like a small differences in the performance of those indexes. It's honestly split in hairs. So one thing that we often say is look at the cost of the fund that tracks the respective indexes. If you really if you're dependent on it, have a look at the fact sheet. Have a look at, there might be slightly higher exposure to US or slightly less exposure to US or other countries, that kind of stuff. But yeah, we're splitting hairs and hairs when it comes to differences between the FTSE All-World and the MSCI All-World. So I hope that clears up. But yeah, I want to read out some of our trends that we've seen among our customer base and II. So it's been a really interesting couple of weeks, as I said earlier. Monday, the 7th of April, was our busiest ever day for trading. And interestingly, investors have been buying more than selling. So it was 61% buys to 31% sells. And that covers a period since the announcement of the tariffs. So that was that Wednesday 3rd. I think it was the 3rd of April, or maybe that was the day after, to now to the 14th. So, our customers have been buying more than selling. They see this as an opportunity. And interestingly, this new record day came 3 days after the previous peak, which was 3 days before, the Friday before, with trading volumes 36% higher than the former record, and also 52% higher than the third busiest day on record. And this was back in the 9th of November 2020, when Pfizer announced its COVID-19 vaccine breakthrough. And that seems like a lifetime ago now, doesn't it? And I think it's quite interesting. And when it comes to the most bought investments, UK blue chip stocks, they account for 7 of the top 10 most bought investments on Interactive Investor since the announcement was made until the start of today. And when I say FTSE blue chips, these include companies such as BP, which is top of the list, Legal & General, and Rolls-Royce Holdings Lee. So our best sellers list has always been dominated by UK stocks. Does this surprise you?
Not really. I mean, it's typically home bias, isn't it? UK investors like UK stocks, more familiar with UK companies. But equally, these are established companies, solid balance sheets, and attractive investment rationales as well. So no, it doesn't surprise me. I mean, BP shares, not just BP. I was going to say BP shares comparatively cheap. Given the sharp decline in oil prices, a play on oil prices, but UK equities more broadly are cheap, and we've seen that sort of for a number of years. UK equities have been largely ignored by international investors, but more recently we've seen international investors look during that period of high valuation, certainly US stocks, start to look for better value elsewhere in the UK.
Yeah.
So we have seen that. So LNG, I mean, that yields after the recent sell-off, just under 10%, modestly valued as well. And you've had Rolls, it's been on a tear for a couple of years under new leadership, big turnaround underway, and it's been a fantastic success story. But if you get up to above £7-8, people start to think that wow, this has gone a long way. I remember when I was buying them, not me personally, but below £1. So they've done a lot.
Yeah.
And people are starting to think, well, how much further have they got to go? But the shares popped down, back below £7 from over £8 to about in the 630s, I think they were, and they become an opportunity again. People get a second bite of the cherry.
Yeah. Also in the top 10 list, Nvidia, Amazon, and the Vanguard S&P UCITS ETF. Thoughts?
I think it just shows that people are buying the dip in American shares. So the US market has fallen more than the UK market. We also have that currency effect I was talking about. So it just shows that retail investors, our customers, think there's value in the US, either via the whole market, with the S&P 500 tracker, or by tech shares that have been amazing over the past decade, but very, very volatile. So Amazon and Nvidia in there. I think it's really encouraging to see on the whole, people are buying rather than selling during our periods, so 6% buys, but also people are buying the shares that they like, that have fallen a lot in value. They're being smart. I think that they're buying the dip. And this idea that retail sells the bottom by the top, I don't think that's true. I think our customers are definitely buying towards the bottom of the market.
Yeah. We've received quite a lot of questions. Thank you very much, everyone, for getting involved. I want to talk about pensions, Craig. I really want to talk about pensions because a lot has been said about its impact on pensioners and also people saving for retirement. I think even if people forget that, even if you don't actively invest through stocks and shares, ISA or a trading account, you still probably have some sort of investment via a pension, right? If you work in the company UK, you have a workplace pension by law. How can, actually there's two parts of the question, how can pensioners or people who are already at retirement approach this current bout of heightened market volatility, and also people approaching retirement, and perhaps people like myself who, some years away from retirement, how can you broach this?
Yeah, it's a very good question. I think those who are already in retirement and drawing down from their pensions in a flexible way, so they've kept the money invested, and those approaching retirement are those who are going to be the most exposed and the most vulnerable to this volatility.
Yeah.
Younger investors, not so much. I guess anyone who's sort of 10 years or more from retirement, the volatile sort of nature of stock markets, as you said, is sort of part and parcel. And even if things do take a bit of a turn, there's plenty of time to sort of recover. But for those approaching retirement, especially those who are looking to draw down from their investments soon, or are looking at their retirement income options, so whether they're looking to buy an annuity or they're looking to use income drawdown, then they may want to think carefully about how they invest between now and then. So, for example, if you're looking to buy an annuity, which is a guaranteed income for life, swap your pot for that. Then what markets are doing at the point that you retire, if you're still investing in stocks and shares, could have a significant bearing on what you get.
Yeah.
In terms of annuity income. So some sort of what they call de-risking, so reducing the level of risk in your investments as you approach retirement, can be a sensible thing to do. If you plan to keep your money invested, then the idea of de-risking, not necessarily you should ignore it, becomes less of a thing. I think it's also worth looking at, checking whether you're thinking about whether your pensions will be affected. If you've got a defined benefit scheme, which will give you a guaranteed income based on your working salary and number of years service, then you'll be protected from this current market volatility. So it would be those where you have a pot. But this whole idea of whether to de-risk or not and what to invest in, it's a personal thing. I would say if you're sort of stuck and you're worried in this area, then probably the best thing to do is to get regulated financial advice.
Yeah. I think also there's a confusion when people say pensions. There's two main types in the UK. There's the defined contribution pension, where you pay into it, your employer pays into it too, right? I suppose a private pension also falls in the SIP, where you contribute to a pension via a platform such as ourselves, Interactive Investor. Also, there's a defined benefit pension, right? That's not necessarily affected by the market volatility, right?
Yes. Yeah. So there's no sort of invested pot for you that you draw from at retirement. You're securing a guaranteed income to use in the future. So it's important to know that. Also, if you've already bought any annuity, so if you've bought a guaranteed income for life already, the terms that you've chosen at outset in the vast majority of cases is what you get for the rest of your life. Yeah. So that won't be affected by what's happened. Depending on what happens with interest rates and long-term gilt yields, what annuity rates will get or what you get offered in the future could be impacted by what's happening now. But if you've already bought an annuity, the chances are that won't be affected.
And obviously this current generation of retirees might have both defined benefit pension and also a defined contribution pension. So if it might be a situation, as you said, every situation's individual, right? So you have to take decisions, based on your own individual circumstances. If you're not sure, get advice. But it might be a situation where someone who's relying solely on their defined benefit pension could also let their defined contribution, the returns free gain. I suppose they can afford to give their pension time for the returns to actually come back again over the long term.
Yeah, and I think that's an interesting one for if you're in retirement and you're drawing down from your investments and you're drawing from shares. If we do get a downturn and we do get a slump, that's something to watch out for. Because if you were drawing money from shares when markets are performing poorly, it can affect how quickly your money grows in the future, because there'll be less in there. Something called pound cost ravaging. That's a nasty piece of jargon. So that's something to watch out for. But then it sort of goes back to what I was saying earlier about having different buckets with different assets. So if markets performing poorly, it can be a good idea. And again, this depends on the individual. If you're reliant on that income, it can be a good idea to pause what you're taking from the equity portion of your retirement portfolio and switch to have a cash buffer. I mean, if you're approaching retirement, then, that's one thing to think about, is to have different types of assets in different buckets. So a cash buffer equal to, 2 to 3 years expenditure, could be more or less depending on, your attitude to risk and what other sort of income you can generate from other assets. That can be a really useful sort of stopgap and safety net to avoid you disturbing the equity part of your portfolio if things do get worse.
Yeah. No, all sound good. Right. I want to talk bonds, Sam. I'm looking at you, and this question has your name written all over it. It goes, amid the sell-off of US Treasury notes, do bonds still serve as a good portfolio hedge?
Yeah, absolutely. In the idea that the US or UK government is going to default on its debts is still just not worth considering. It's just, there's no clues that's going to happen. I mean, some whisperings out the US, but it's highly, highly unlikely. So these safe government bonds will continue paying their coupons. They will redeem at the right price. I think what we've seen in bond markets is that there's been some doubts over, I would say, a bit of a confidence crisis around the US government at the moment. So people have been selling their bonds, which has driven up the yields. So if you're holding those bonds, you've probably seen a bit of a capital loss. You're still going to pick up the income. I still think they're a good hedge. But what this is kind of being compared to a Liz Truss moment for Donald Trump. I think that's completely right. We've seen a confidence crisis, and actually, interestingly, it was the bond market which forced the turnaround, not the equity.
Yeah, that's right.
So rising US bond yields caused by selling, it means it's more expensive for the US government to borrow money. It's more expensive to borrow money. It's got less money to spend in other areas. And actually, one of the main goals of this administration is to lower the cost of the debt. And they're achieving the opposite at the moment because markets just don't trust them. So could that be reversed? Absolutely. Do bonds still serve as a good hedge? I think they do. I think if we see a recession, interest rates will come down. That's going to boost bond prices. You're also getting way better yields than a few years ago. So between 4 and 5% in the UK, similar to that in the US. So even if bond prices don't move, still picking up the income. If they move linked to a recession and interest rate cuts, you're going to get some capital gains there as well. So yeah, definitely some doubts over the US government at the moment, but actually bonds as a hedge, I think they still work and definitely worth owning. And if you've owned them recently, you're going to be in a better position than if you just owned equities.
Yeah. One thing I thought was quite interesting is 10-year gilt yields, right? They've crept up. I think last I checked was around 4.7%. However, and these gilts are the ones that lenders, mortgage lenders use to help price their fixed rate mortgage deals. Interestingly, the market's pricing in additional interest rate cuts this year. How do the two reconcile? Lee, perhaps you might have some insight on this.
Yeah, well, I mean, if the interest rates come down, as you said, that the rates of mortgage rates come down as well. So, and that makes it more affordable for everybody to pay off their mortgages when they come to take out a new offer.
So that's almost a silver lining. If interest rates are expected to fall quicker, then I suppose the silver lining of this whole issue, this whole couple of weeks, market volatility is we could see cheap mortgage rates.
So, yeah, I mean, you do see cheaper mortgage rates, and it's cheaper to borrow via other means as well. Obviously, savers won't be very happy because the rates on your savings accounts will come down as well.
Yeah, but isn't there worry that with tariffs, it will stoke inflation? So perhaps it's the balancing act, isn't it, that Bank of England has? It's yes, there might be increased inflation because of the tariffs. However, the UK economy is not necessarily booming, is it? I know economic growth, GDP grew by 0.5% in February, right? That was the first decent bit of news regarding our economic growth for a while because it has been stuttering for so long. But I suppose we still need more growth. That's what we need. So, I suppose the Bank of England will be looking at, we need growth. There's a risk of inflation, but growth, this is a big factor, and this is something we need to address at the moment.
Yeah, I think also with the interest rate cuts, I mean, it's been good for borrowers, particularly those with who have deals expiring in the near future, to see rates coming down. So that's been a good thing, but things can change and have been changing very, very quickly.
Yeah.
So think that's the thing to sort of be aware of as well. Donald Trump has shown that he's incredibly erratic. So how things will look in, 2 months' time, 3 months' time, that's, just under 90 days seems to be going to be a big factor. But how things are going to look in the short-term future, we don't know. So things can change and have been changing incredibly quickly.
Yeah. We have a question regarding gold. I think either Leo, you mentioned it earlier as a haven asset. How can you position gold in such a time like this within your portfolio? Or should it be considered?
I think everyone should be looking at it. I saw one of the analysts today came out with a $4,000 price for an ounce of gold.
Yeah.
Quite an uplift on that. It's about 3,100, 3,200 today. How much should you have in gold? It's your portfolio. 5% might be prudent.
Yeah.
I think if you had any more, you'd be very happy about it. Maybe you want to trim a little bit. Going above 10% feels like quite a lot for what is just the precious metal. It's not giving you any income. We don't know what the future holds. I think there really is a flight to safety at the moment. And because there's these worries about the US government and inflation, bonds haven't really held up. Yeah. So actually gold is the one thing that's working. So yeah, if you don't have any, definitely take a look at it. If you've had a lot and it's done really well, often during these difficult periods, sell what's gone up, buy what's gone down. That can be a successful strategy.
Yeah.
Which it depends how sort of engaged you are with your portfolio as well. I mean, if you're a reasonably sort of confident investor, you might wish to sort of and you enjoy sort of allocating or having specific allocations within your portfolio. That's great. I think it might be 5% of your portfolio or something, but then people will equally argue for an allocation to Bitcoin and things like that. So individuals, as Sam says, really have to take it. Make their own decisions. What are you comfortable with? Yeah. Are you worried about having gold in your portfolio? Some people will want to follow that allocation process religiously. Others might think, well, you know what, it has done well, but I can do without it. The sky's not going to fall in if I don't have gold in my portfolio. Yeah. Similarly with Bitcoin. And we have seen gold price come off. Speculation as to why that might be, whether it's profit taking or trimming positions in gold to cover losses elsewhere, that type of thing. But I mean, the overall trend at the moment seems to be up. People were saying at 2,800, or it's gone up a lot already. It went up further. It went up to 3,000. Now it's gone beyond 3,000. Of course, it could go up to 4,000. Yeah, my belief is that the circumstances would have to be a heck of a lot worse than they are now for it to get anywhere near 4.
Yeah. And we also have quite a few questions in asking, looking ahead, what regions stand to benefit, what assets, and also one saying, how should UK investors reassess exposure to international markets, especially emerging economies, rising geopolitical tensions and deglobalization? I think it's a really, really interesting question. And honestly, the answer is, I know we say it all the time, but, there's a reason why we say it. It's diversification. It's so important to have a well-diversified portfolio. No one short of a functioning crystal ball can tell you what might happen in the future. And so it's really important to understand your risk profile. It's really important to understand your investment time horizon. These are like our 101 lessons, isn't it? Anytime we do something in the media, go to schools, this is something we always say because it's just so important. People often look at the news, will often look at things on social media on investing, how to do this quickly, how to do that, how to make money, with very little effort. That there is no shortcuts to, making sure you have a diversified portfolio and making sure you're investing for the long term. When we say long term, that's at least 5 years. History shows that over long-term investments, some market investments have a good habit of actually producing a really decent return that outstrip any cash savings products and also outstrips inflation. So I think it's a really basic answer, but it's a really important one to remember.
Yeah, I think that sort of goes back to the question about, do you have any advice for investors other than not to panic? And I think that's one, is to revisit your portfolio. Yeah. And just to make sure that you're comfortable with the level of risk, that you're diversified. Check your your financial goals, the length of time that you have towards them. So if there's some that you're nearing, so I guess, for example, if you've got money in stocks and shares and you're looking to buy a house in the next year, you might want to rethink. It doesn't mean you should necessarily do anything different, but I think it's a really good time just to revisit things, because a lot of time can pass between when we set investments up, and then as we get closer to our goals, the types of things that would be more appropriate for us to invest in can change. So I think that's one of the takeaways at the moment, or one of the important ones.
Yeah, I completely agree. There are many other questions, all kind of relating to the same topic. And perhaps it might be worth talking about cryptocurrencies. There's a few relating to Bitcoin cryptocurrency. That's had a really interesting year, isn't it? Like, it's dropped off from highs of just, my Bitcoin dropped off highs of just over $100,000. Now, it's I can't remember exactly where it's tracing that, but that in itself remains heavily volatile. Can we agree on that?
Yeah, it's certainly not an area of my expertise. I have a passing interest and understanding of it, but in terms of trading, yeah, as you say, over $100,000, that was a big sort of landmark moment. Now in the 80,000s, I think.
Last time I saw was 85,000 last week.
Yeah. So it's Marmite, isn't it? It's one of those assets that you love or you hate. Some people stay away from it; they don't understand it. It's not straightforward, and other people are disciples.
I have a motto. I always stick by it. Don't invest in things you don't understand. Otherwise you don't know what good looks like. You don't know what bad looks like. It's as simple as that, man. But as you said, each to their own. We're not here giving financial advice. We're here just to have that conversation and offer some guidance. So I think we should wrap up, actually. Any final thoughts in terms of how people should broach this current market volatility? Like, for me, I like to reinforce the don't panic sentiment that's been shared and also has been heard by our customers. They're keeping on and carrying on actually in the big way, in terms of they see this as a buying opportunity. But again, each their own. Not everyone has cash to top up their investments. We say, when it comes to investing, make sure you have enough money in your rainy day fund, your broken boiler fund, to make sure you're taking over should the worst happen. We usually say between 3 and 6 months worth of living expenses, costs. But there is an opportunity, and to ride out the storm and actually having the positive impact on your wealth generation over the long term. And that's the key term, over the long term, 5+ year. It's all about time in the market, right? And time in the market.
Yeah, I think it's to keep focus on your financial goals and the things that you want to achieve. If they're many years into the future, as you sort of alluded to, then this should be less of a concern. In fact, if markets have dropped, then it could be a buying opportunity. I think we've covered that throughout. But that's the thing. Don't do anything on a whim. If you can avoid so, and keep focusing on the things in life that you want to achieve.
The markets are often the best time to be regularly investing as well. I know from personal experience, I was buying Scottish mortgage up at much higher levels. Saw it come all the way down, but just kept buying regular monthly investments. It's come up again, break even, decent profit. It's just the way things work.
On that, actually, Sam, drip feeding your investments versus lump sum, thoughts?
If I had 20 grand, I'd just moved it into my ISA, and I was trying to figure out what I wanted to do with it. It's a difficult one. I would actually put it all in. on that chaos. The chaos happened.
Yeah.
The very opening of the new ISA season, I would have looked at that 20% bear market. I think I would have put it in, because the data shows equity markets generally go up over the long run.
Yeah.
So actually, the more time you are invested, you can pick a really bad moment. It's probably actually a great moment long term, but drip feeding, way more sensible, way more easy to manage.
For nervous investors,
most people, that's probably the right thing to do.
And it was not just for ISAs, but also pensions. You could just make the most of these tax-free allowances, because it really does pay dividends over the long term. Brilliant. there are so many more questions. Maybe we can do a part 2 of this. But for now, Jed, thank you very much for joining me. And viewers, I hope you found this useful. Let us know how you found it. And please keep your questions coming in. But until next time, see you later.